Okay, welcome. My name is Kyle, and this is going to be an e-tutorial on how to solve problem E17-13 from the Pearson workbook. So what we have here, we have an income statement of Flashpoint Consulting. We have a comparative balance sheet at September 30th. We just have current assets, current liabilities, so it's just partial balance sheet data that we have for the same company, Flashpoint Consulting. And then we have additional information down here as follows. So they acquired a computer system, and it tells us they paid by a combination of cash and a long-term note payable. They received cash from the sale of land. They received cash by issuing common shares. They paid down some note payable, and they paid dividends. What's the overall cash balance? Okay, so we're going to do a cash flow statement in order to figure out that. And I'm going to do a cash flow statement now through the indirect method. So I'm going to fill out just a template for us to get us started. So I know the cash flow statement is an official financial statement. It's a requirement. Therefore, it's an external facing document, and as such should follow common financial statement conventions. That means including 3 financial statement title lines. So that's going to include what the organization name is, Flashpoint Consulting. This is the statement, cash flows, and this is for the period, for the year, I should say, ended September 30th, 2020. So I've got my 3 title lines of my cash flow statement. I'm also going to use this as an opportunity to just put in subtitle lines, subheadings, because I know the cash flow statement is divided into 3 subsections. You have cash flow from operating activities, cash flow from investing activities, and finally we have cash flow from financing activities down at the bottom. Now you can already tell immediately I didn't really prepare well in advance here because my template that I've given myself kind of overlaps with this requirement of the question. So let me just move this down and way out of the way. I probably should read what's required as well. So prepare Flashpoint Consulting cash flow statement. Okay, so yeah, September 30th, using the indirect method. Okay, that's important for us to know. And then evaluate cash flows for the year. In your evaluation, mention all 3 categories. Okay, so the main requirement here is to prepare a cash flow statement using the indirect method. Glad I got the date right, September 30th. I glanced up and took it from here, hoping that it was going to be the same period. But anyway, so I'm pretty happy with my template here. I might need to adjust my lines to make sure there's enough space. I don't know, haven't done this problem, so I don't know how much space I'm going to need, but luckily I have the luxury of doing this in Excel, which means it's very easy to add or subtract lines. But I know cash flow statements is subdivided into 3 sections: operating, investing, financing. I've got those 3, and I'm almost ready to start. What I want to do is just a quick little discussion about this indirect method. So using the indirect method, the operating activities section, of course, is the only one that's impacted. Whether it's the direct or indirect method, the way of preparing both the investing and financing activity section stays the same. Only the operating activity section changes. And it's really just 3 steps. We start with net income. Then what we do is we make adjustments for non-cash items included in net income, NI, net income. And the third and final step is, what are the changes? What are the working capital changes? So 3 changes in working capital. And of course, working capital is current assets and current liabilities. So I'm going to be referencing those 3 steps as I go through and advancing through this problem. But this is really only going, these 3 steps are only applicable to the operating activities section. So it tells me in our 3 steps here, start with net income. So I'm gonna start with what net income is. I'm gonna go to, of course, the income statement in order to figure out what net income is. It tells us net income is 120,000. So I'm just gonna start by putting 120,000 on my cash flow statement. And that was pretty easy. We're off to a good start. I'm already done with step 1. Step 2 then is looking through the income statement and figuring out what non-cash line items are included on the income statement. So of course there's non-cash line items on the income statement. A good example of this is amortization, right? When we amortize an asset, we debit amortization expense, and we credit an asset. So it's a non-cash journal entry that impacts profit. So since that impacts profit, but it doesn't impact cash, we need to add that back as an example to net income. So let's look through the income statement now, and we'll pick out all of the non-cash line items, and then we'll make an adjustment for it on the cash flow statement. So I'm going to just start here, revenue, and go down. Okay, I can see that they have amortization expense of 58,000. Rent, office, insurance. So all of these other expenses, amortization here is really the only one that's an obvious non-cash line item. Other ones could be a gain or loss on sale of asset. Right now, the only one that's obvious on the income statement is this amortization expense. So I'm going to give myself kind of a subheading, adjustments for, I'll say, add or deduct. Items that affect net income, cash differently. And amortization expense is a really good example of that. Amortization affects net income, but it doesn't impact cash. So amortization expense was 58,000. And that was the only non-cash line item included on the income statement. So I'm already done with step 2. We're doing pretty good. Whoops, didn't want to highlight that. Wanted to put a big cross through it in celebration that we're already done step 2. And then step 3 is, what are the changes in working capital that also affect net income? So for that, we of course would have to go to the balance sheet, and we would have to compare 2 years worth of working capital items. Now, working capital, of course, includes current assets and current liabilities. And we need to have 2 years worth, and we need to incorporate the change from year over year. So this template, if you're in the workbook, it came with this, just as it is. We have 2 columns, one for each year, and then we have an increase or decrease. Since I'm doing this in Excel, it's going to be very easy for me. I'm going to take my 2020 amount, subtract my 2019 amount, and I can just copy and paste this down below to see. Okay. So then I can go line by line, and I can see it here. I have 6 lines. I don't have enough space in my template. So my apologies about that. I'm just going to do this right now, create more space, and then we can move forward. So I can see here, I included cash. Now we're trying to figure out why cash increased or decreased by 20,000. And we can see if I highlight this in my cash flow for operating activities section, we're trying to figure out items that impact net income and cash differently. So we're trying to figure out why cash went up 20,000. I'm not going to make an adjustment on my cash flow statement for cash. I do it for all items that are current or non-current other than cash. So I'm going to start here with accounts receivable. Accounts receivable was 30,000. It was 144,000. So that's a decrease in accounts receivable. So I'm going to say decrease in AR, 114. So many of you are probably wondering, okay, well, a decrease in accounts receivable, it's negative. Why did I just input it as a positive number in my cash flow statement? The reason for that is accounts receivable went down. That has a positive impact on our cash. How so? Well, I know when we collect on accounts receivable, the journal entry is cash, debit, accounts receivable, credit. So accounts receivable goes down, has a positive impact on cash. So I have to add that into my net income, into the net income amount. When accounts receivable goes down, it basically means, well, we're collecting cash from customers. So of course that has a positive impact on cash. Next is office supplies. So there was an increase here of office supplies. This time, however, there's going to be a negative impact to cash. Cash is going to go down. So how could that possibly be? Let's just think about this for a second. What happens when we buy office supplies? Well, when we buy office supplies, of course, we know office supplies are an asset. So assets go up, office supplies go up. And how did we pay for office supplies? You have to pay for it somehow. So likely cash goes down. So an increase in office supplies is going to decrease cash. Okay. So prepaid expenses, there's no change. So since there's no change, we don't need to do an adjustment for it. And then we have accounts payable and accrued liabilities. So accounts payable went up. So increase in AP. So this increase in accounts payable is going to be added back to cash. Now think about this again. That's a $12,000 impact. Let's think about accounts payable. And maybe it's easier to think about it from the other way. If accounts payable goes down, that means this organization is paying suppliers, so cash is also going to be going down. So if accounts payable is going up, that means cash is going up. Now that's a little bit harder for us to conceptualize. So let's just think about this, what a potential journal entry would be. So let's say an organization bought, I don't know, it doesn't really matter. Well, let's look at their income statement. Insurance expense. So let's say with their insurance expense, the journal entry was insurance expense, accounts payable. They paid for their insurance on credit. The journal entry would look like that. Debit, insurance expense, credit, accounts payable. Now, we just, with step 2, went through the income statement, remember, and we adjusted for all of the line items that were non-cash. Now, amortization obviously is non-cash, but that doesn't mean that they've paid for every single expense. Of course, they would do a journal entry to debit the expense, credit accounts payable, but if they actually haven't paid for it yet, that means what we're basically doing with this is we're adjusting net income for items that we haven't paid for yet, but we've recognized the expense for. So that's the rationale behind why accounts payable, an increase in AP, would be an increase to cash. They're expenses that we haven't yet paid for. So increase to AP, add that back to cash. And then we have accrued liabilities, same rationale, although this time it's a decrease. So decrease in accrued liabilities. And this, of course, is going to decrease our cash balance. So let me just get rid of this markup over here because I think I'm probably going to need it. Okay. And then I can say net cash provided by operating activities. I'm done because accrued liabilities was the final line item on the balance sheet. And we only had 3 steps of doing the cash flow from operating activities, right? We started with net income. We did the adjustment to non-cash line items on the income statement. Then we did adjustments to working capital, which was current assets and current liabilities. So we're done with the operating activities section. So I can total this up. And cash flow provided by operating activities is $288,000. Okay. Cash flow from investing. So investing activities include the purchase and sale of long-term assets. And you know what? Since I'm done with our 3 steps, maybe I'll utilize this space over here. Now, we've already completed, and I'll just talk while I erase, so hopefully you're cool with that. We've already done everything we need to do with what was provided on the income statement. And we were only given current assets and current liabilities. So we're already done with everything from this comparative balance sheet, with the exception really of this change in cash, 20,000. What we're going to hopefully see is once we're done with this cash flow statement, that our cash did in fact increase by 20,000. That's the only thing that we really need from this problem, which means that everything else we need from the investing and financing section is going to be included in this additional information section. So we're going to be given line items or questions that look like this. So acquisition of computer equipment, remember computer equipment is a long-term asset, was 232,000. Of this amount, 202 was paid in cash and 30,000 by signing a long-term note payable. So when we make investments in long-term equipment and we pay with cash, that's a cash outflow. The journal entry would look like this in this case. So it would be computer equipment, computer equip would go up by 232. I'm going to call it K for 1,000. And cash went down, it said, by 202. And a note payable, I'll call it NP, was the difference, 30,000. So here, the acquisition of computer equipment, the cash that it provided was a cash outflow, right? Cash went down by $202,000 to pay for this, to finance the acquisition of this investment. So that's part A. Part B, cash received from the sale of land. So whether you're either purchasing or selling assets is included within this investing activity section. So cash proceeds on sale of land, and it was 20,000. Part B. Part C is common shares. D is note payable. E is dividends. So the remaining 3 here are all financing related activities, which means that what I'm going to do is provide a subtotal, net cash from investing activities. And I'll do just sum those together. It was a cash outflow overall of $182,000. And I can move this up a bit. And then cash flow from financing. So where was I? Cash received from issuance of common shares. So remember, when you issue common shares, the journal entry is going to be debit to cash, credit common shares. In this case, it is 84,000. So that's a cash inflow. So cash received by issuing common. It was $84,000. Next up, it was payment of a long-term note payable. Now think about this. We're decreasing a liability. Note payable is going down by 40,000 because cash is going down by 40,000. And just, okay, to make that clear. So that's going to be payment of note payable. It's going to be a decrease to cash of 40,000. And then finally, I think finally, the very last one, payment of dividends. So when you're paying dividends to your shareholders, because shareholders originally provided this organization with money, they expect to be compensated. It comes out of the financing activities section. So dividends paid, type. And the amount here is 130,000. That's a decrease to cash, right? Dividends are paid out of retained earnings. So it would be a debit to retained earnings for dividends payable, divvy payable, retained earnings. And then when dividends are paid, we would debit the liability, dividend payable, and credit cash. So cash would go down if the dividend is paid. And here it tells us the dividend payment of 130,000. So then we're done. Net cash from financing activities. See here. Okay. And then to conclude the financial statement, I'm just going to have a couple more lines. We're almost there. The final one, what's next is going to be the net increase or decrease in parentheses if it's negative in cash. And I get that just by summing everything we have in this far right column. And my fingers are crossed, it's 20,000. I didn't do this problem in advance. And of course it doesn't match. Oh, and the reason it doesn't match is because I did a sum of everything, but I have a subtotal here. So I should just need to do up until the 288. Okay, 20,000. It's funny that that didn't work out the first time, but I know that we needed 20,000 as a result of an increase in cash because the problem told us here cash increased by 20. So that's good. I know that I've done this problem right. And then just to conclude, I'm going to have a section here that's cash balance at beginning of period. And this is at September 20th or September 30th. Sorry. So the beginning period, I'm going to just say at beginning of period, and then cash balance at September 30th, 2020. So the cash balance at the beginning of the period, we know was $36,000. And I can get the ending cash balance now by just adding those two together. And of course, it's going to match this 56,000 is going to match what is up here from our balance sheet. So let me just double underline the second, double underline the second one to indicate there's no further calculation. So that is a double underline. It might be tricky for you to see. And then we're done with the statement of cash flows. So it's over here divided into three separate sections. It had positive cash flow from operations, which is a very good indication. It invested in itself by buying equipment, which is another good indication. And it still had cash left over to pay dividends. So that's looks like it's a fairly strong organization. Now, the only thing I want to comment on before I close this is remember the journal entry I did for part A here? It was computer equipment was debited by 232,000, but they financed that through a combination of cash. Cash was 202. Oops. 202,000, and then they had a note payable, I think, of $30,000. So since they didn't finance the entire computer equipment, or since they didn't pay for it entirely with cash, they would have to disclose in the notes to the financial statement that, it would say something like the company issued a long-term note payable for 30,000 in partial payment for computer equipment, something to that effect. And now we're completely done with this problem. We can put our hands up and celebrate. So thank you guys for following along with me. This was problem E17-13 from the Pearson workbook. If you have any questions, feel free to reach out to me or to anybody. Happy to help you out. Hope you're doing well. My name is Kyle. I hope you found this useful. Have a great day. Take care.